Inheritance tax. What does it mean for you? People have often heard of inheritance tax, but are often unsure how it might impact them. So today I'm going to cover who is impacted and why it might be worth thinking more about IHT. In simple terms, IHT is applied on an individual's estate if the total value is higher than a certain amount, which is known as the nil rate band, and I'll cover a number of examples as we go through today's video. So, what counts as being in your estate? Your house, any other property that you may own, your investments, items such as your home contents, furniture, antiques, collectibles, cars, valuables such as jewellery, watches, any assets that are in trust which you benefit from can still be in your estate, and also gifts that you've made within the last 7 years. Gifts is an interesting one. As we'll go on to talk about later, gifting can be a sensible way to reduce the value of your estate, but as a gift is made in the last 7 years before you pass away, it would actually fall back into your estate, and we'll cover that more as we go through the video. So what isn't included in your estate? Your pension isn't included in your estate as long as it stays within that pension wrapper. This can make pensions a very tax efficient way of passing funds on to your loved ones. So, who pays inheritance tax and how much? I'll start first by explaining more about the nil rate band, which I mentioned earlier. The nil rate band is a limit on the amount your estate can be worth before your beneficiaries are subject to an inheritance tax charge. The nil rate band is currently £325,000. This means that if your estate is worth less than this, when you die, your loved ones don't have to pay any inheritance tax on their inheritance. In addition to this, the residential nil rate band applies specifically to your home. If you intend to leave this to a direct descendant, such as a child or a grandchild, then the residential nil rate band of £175,000 will apply, as well as the nil rate band. This essentially allows an individual to leave assets of £500,000 to their beneficiary as long as they qualify for the residential nil rate band. There won't be any IHT to pay. If your estate is over the nil rate band, then you'll be subject to inheritance tax charge of 40% on any of the excess. Let's look at an example. Robert is divorced and has passed away aged 87. He has a house that's worth £250,000, investments that are worth £150,000, and other items such as a car and furniture that are worth around £20,000. Robert's total estate is therefore worth £420,000. If Robert had no direct family members, his estate would be in excess of his nil rate band, that £325,000 figure, and an inheritance tax charge of £38,000 would apply to Robert's estate. If he had children and his property was to be left to them, then he would qualify for the residential nil rate band, and therefore his assets of £420,000 would be less than the available £500,000, and no IHT would be due. We are often asked how IHT works for a married couple. Each individual has the nil rate band and potentially the residential nil rate band that I've just described. Because transfers between spouses and civil partners are exempt from paying IHT, therefore, if you leave your estate to your spouse or civil partner, there'll be no IHT to pay on the first death. As well as the assets being left, the surviving spouse can also inherit their partner's nil rate band. Therefore, on second death, instead of the £325,000, the surviving spouse can potentially use 2 nil rate bands, which brings that figure to £650,000, and 2 residential nil rate bands, which brings it to £350,000. This brings the total amount to a potential exempt amount of £1 million. As a worked example, if Janet and Roger are married and they have the following assets: a house worth £300,000, investments of £200,000, and other assets of £100,000, this brings their total estate to £600,000. If Roger passed away and left everything that was in his name to Janet, there'd be no IHT on the first death. When we came to the second death, if the values of the assets had increased and the house had gone up to 350, say, and the investments 250 and other assets were still 100, that would leave 700 in total. Assuming that Janet leaves the main residence to a direct descendant, then she can potentially use the 2 nil rate bands and the 2 residential nil rate bands, and as that 700,000 is less than that £1 million figure, then there'll be no IHT payable. So, If you have an IHT problem, what can you do? You could spend money or gift money to reduce your overall estate. As I mentioned earlier, you do have to be a little bit careful about gifts and these potentially falling back into your estate if you pass away within 7 years of making those gifts. So it's worthwhile reviewing your position formally with a solicitor or a financial planner if you are considering large gifts. There's also exemptions and reliefs that can be used to reduce the amount of inheritance tax that might be due. For example, certain assets can qualify for business property relief or agricultural land relief. It's important to note that inheritance tax can be a very complicated situation, and we would always recommend speaking to a financial planner when reviewing your affairs to make sure that your estate is structured in the most tax efficient way. There are also various strategies and planning techniques that can be used to reduce the impact of an inheritance tax charge, such as making use of annual gift exemptions, potentially setting up trusts, and making charitable donations. If you're worried that you might have an inheritance tax problem, or you want to understand more about your estate, and you would like some personal financial advice, please feel free to get in touch.